Good afternoon and welcome to our summer term money webinar series by the Institute of International Monetary Research in collaboration with the Vincent Centre for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damien Pudner, Director of the IIMR, and today we are delighted to be hosting Kent Matthews. Kent is the Sir Julian Hodge Professor of Banking and Finance at Cardiff Business School, University of Cardiff, and Professor in Banking at Nottingham University Business School, University of Nottingham, Ningbo, China. He has a PhD in economics from the University of Liverpool under Patrick Minford, having received his MSc in economics at Birkbeck College, University of London. Kent has held academic positions at Liverpool John Moores University and several visiting academic positions, including at Fudan University, China, University of Western Ontario, Canada, Clemson University in the US, Humboldt University in Germany, and Leuven University in Belgium. He has also held visiting professional positions at the Bank of England under Charles Goodhart, Lombard Street Research Limited under our own Tim Congdon, and the Hong Kong Monetary Authority. His areas of interest include bank credit and SME financing, shadow banking and the Chinese macroeconomy, and money and banking deregulation in developing economies. Although his research has also taken him to areas of economic forecasting, economics of crime and violence, tax evasion, and money laundering. He has published over 100 peer-reviewed papers in scholarly journals, including the Journal of International Money and Finance, European Journal of Operational Research, Journal of Money, Credit and Banking, Journal of Banking and Finance, European Economic Review, Economic History Review, and Oxford Economic Papers. He has authored or co-authored 7 research and textbooks, including the 4th edition of The Economics of Banking and the 11th edition of Economics. Today, we will discuss inflation expectations versus money, after which we hope to allow time for a Q&A with viewers online. As always, today's presentation will be recorded and made available on our YouTube channel. Please visit our website, www.mv-pt.org, to access this and other webinars in our series. A reminder that questions must be submitted via the Q&A option, which I will moderate and address to Kent. And with that, I'll hand over to you, Kent.
Well, thank you very much for that very generous introduction, Damien. I somehow failed to recognize myself fully in that, but thank you very much. Yes, so I want to talk about inflation expectations versus money today. This was a question that was put to me some years ago at one of the conferences that the IIMR ran some years ago, and I got interested in this, and I thought that this topic here is worth another visit. And I want to start off by asking, what drives inflation? And what underlies the subject of today's talk is it money growth or is it inflation expectations? Now, why is this interesting? Well, it's interesting because there's an attitude which is recorded in Mervyn King's book, says that central banks think or thought that if you were to influence expectations of inflation, then you can deal with inflation directly without having to deal with the transmission mechanism or about the fact that what determines inflation, which I would argue is money. Now, the idea that money affects inflation is incontestable. I mean, there's a huge history that has this as its foundation. The quantity theory of money is the foundation, and the philosopher economists of the 18th and 19th century of Locke and Hume have been credited with the beginnings of that theory. At least that's what I was taught when I was an undergraduate. But in fact, recent scholars show that it goes back even further to the 16th century University of Salamanca economists who debated the influx of gold coming into Europe, the 14th century theologian Oresme, and in fact, Chinese scholars are now saying that in 14th century Ming Dynasty, Chinese scholars were talking about or referring to money in that form that existed then, and inflation. So huge historical pedigree. Of course, modern quantity theory of money was given a boost with the theoretical and empirical work of Milton Friedman, who forever is associated with the term inflation is always and everywhere a monetary phenomenon. Now, while, you know, after Milton Friedman, the counter-revolution, it seems to me there was little disagreement about the effects of money on the economy. There might be some who argued, you know, how much that meant to the economy and inflation, but that debate also broke out within the monetarists camp themselves, who supported the notion of the quantity theory of money and that money ultimately drove inflation. And that debate was about which measure of money, you know, which measure of money should be used. There was a whole series of money measures, from monetary base M0, M1, M3, M4, and so on. And that debate broke out in the late 1960s and published in the 1969 first issue of the Journal of Money, Credit and Banking. And that debate was between Friedman and Schwartz and Pesach and Saving. And basically the idea that Pesach and Saving had was that the measure of money had to be separated into the roles of money. Now, we all know what the roles of money are. I mean, money has to be a medium of exchange and a store of value. And what Pesach and Saving was saying is that the measure of what they called moneyness in money is given by its ability to be used for transactions. And the measure of non-moneyness was that bit which is being used for savings, the store of value. And they went on to argue that the interest rate, the difference between the interest rate on a non-money savings asset, say, so like a treasury bill, less the rate of interest you pay on bank deposits was a measure of moneyness. So if a bank deposit paid the same rate of interest as say, a market treasury bill rate, then people would hold that like a savings. Well, of course, that notion was questioned by Friedman and Schwartz, because it seems crazy to think that if money paid the same rate of interest as a treasury bill, it will be the treasury bill that will go out of existence, because money would offer two goods. It would offer two functions, rather. It would offer transactions function and a savings function. And the fact that it's a lower rate of interest is that it's offering this transactions function. What Friedman and Schwartz argued was that this issue of moneyness that Pesach and Saving were talking about really was confusing the marginal utility of money in transactions against the average or total utility. Friedman and Schwartz argued that a bank deposit offered both services, both transaction services and store of value services. And the store of value service, well, it's a joint good, right? It's a joint product. And by offering one service, it was giving the other service free. So the marginal utility of the transaction service will be zero at that margin, because they'd be using that money for transaction services, but of course, it's also a savings function. As a savings function, it can be used on demand for transactions anytime. And that is encapsulated in Friedman's famous saying that money is a temporary abode of purchasing power. Now, that debate meant that Friedman very much sided on the broad money measure, whereas Pesach and Saving spawned another literature of research, which was the divisia money measure, which somehow tried to weight money by its savings functions and gave a full weight to narrow money as a transactions, but then a lower weight as it went up the savings spectrum. Now, in contrast to that, there was an empirical literature that was going on at the same time. And what that did was that they simply took measures of money and looked at how good it was in explaining nominal income. So there was an empirical literature which favored actually narrow measures, and that was the followers of Friedman, The Chicago school, like the St. Louis Fed, they argued for narrow money measures because that was the best fit with nominal income. Whereas theoretically, Friedman and Schwartz tended to favor the broad money measure. Now that debate carried on also in the UK, and Tim Congdon argued very strongly for the broad measure, and Patrick Minford and others, Alan Walters, they argued for the narrow measure. That debate is no longer going on, which makes you think that, you know, the broad money school won the day and the other ones have just gone quiet. And so that debate has now been put aside, and we can now go on to look at expectations, right? So we've dealt with money. I think the theory is very important. We also dealt with the measure of money, and that's very important. And we've come to a conclusion about the schools of thought that support that. Okay, what about expectations? Well, we all know that expectations is also important to economics, and scholars of economic thought find references to business expectations and the distinction between the money rate of interest and the real rate of interest in the writings of Marshall. When I attended my lectures in monetary economics, I was told that Marshall actually had in his footnotes, when he referred to the Cambridge K, that, you know, there was expectations implicit in there. Well, you know, expectations is obviously very important in economics, and it was in terms of inflation expectations, it was actually Friedman and Phelps in 1968 explained the breakdown of the Phillips curve relationship, brought in the expectations augmented Phillips curve. And their argument was that the basic Phillips curve failed to take into account inflation expectations. So money is important, right? The measure of money is important. Expectations is important. Then inflation expectations is important. How do we measure expectations? Well, according to Schiller, there are direct survey methods, and we're lucky that we have data on that. And then there are indirect or proxies that which we can infer from other variables. So for instance, nominal interest rates reflect inflation expectations. Given assumptions about the real rate of interest, we can back out what the implied or implicit inflation expectation is. Now, the monetary transmission mechanism is also something that economists have debated about a lot. And the thing that differs between the Keynesian school of thought and, say the monetarists, is really that the monetarists tend to argue that you couldn't actually always model the way money affects the economy, whereas the Keynesians were very strong on the idea of doing this. They would say that, yes, an increase in money would affect interest rates, and this would affect the cost of capital, and this would affect the value of assets, and these two together will influence investment expenditure and consumer spending and so on. And you should be able to model these through a set of structural equations. And during the 1960s, that's the way modeling went. And the 1970s, we build large structural models which try to model the role of money through the various equations, structural behavioral equations that affected consumer spending, investment spending, and so on. In contrast to that, Friedman and Meiselman and Anderson and Jordan, early period, said that actually it's impossible to model the way money affects the economy. And therefore, you should go directly to the reduced form. You should use money as a variable that explains nominal income. And therefore, they want to argue that you could explain much from little rather than try to complicate things with a large structural model. Now, the reasoning for the reduced form approach is that money affects the economy through many ways, and it's not always the same every time you have a monetary impulse. And the analogy was the sluice gate. The farmer would lift the sluice gate to allow the water to come in to irrigate the field, And water would come in all different ways, and it'll do it differently each time. And you couldn't always model that. You wouldn't know which way the water is coming. But what you do know is that when it's reached its equilibrium, water is at the same level everywhere. And that's the kind of thinking they had, that somehow they modeled this mechanism of money affecting nominal income, but in equilibrium, there will be a relationship between nominal income and the stock of money. Now, behind all that was this notion that the central banks had this idea that you could influence expectations and cut through the channels debate, this whole business of trying to model, how money affects the economy, whether it's a reduced form or whether it's a structural form approach. You can cut through this by simply going directly to expectations. And you could anchor inflation expectations by having a credible policy, by targeting it. Once you target it and people expect that, then you can cut through all the channels of monetary policy and directly affect inflation. So that's what I think is behind this issue about whether it's money versus inflation expectations. As you will see, as we get to the end here, I'm going to argue that there's no money versus inflation expectations, but they are both the same thing, that to really get at inflation expectations, you've got to have monetary policy correct, and you've got to have monetary growth consistent with the target inflation to give inflation expectations credibility. Okay, so let's back up a bit and ask, what drives inflation? So what kind of theory underpins inflation determination? And what kind of theory determines expectations of inflation? And are these two theories independent, or do they interact? Now, you can guess that what kind of theory underpins inflation determination. It's going to come from the quantity theory, but there's got to be some notion of how that affects the economy. We simply can't go down the black box route of saying, well, there's money and somehow it affects nominal income through some black box which we don't know about. We've got to have some idea about how it does that. Whether we go into so much detail as the structural form models that existed in the 1960s and 70s, when I worked at the National Institute, we used to have very large models, 200 equation maybe, I can't remember, but do we need something as big as that? Well, let's look at something like that. A simple model, perhaps. Well, let's start off with the monetarist perspective, where inflation is always and everywhere a monetary phenomenon. We already said that with Friedman, and inflation is a steady and sustained rise in prices. Now, in the quantity theory restatement, Friedman said the income velocity of money is stable and predictable, but, and I quote, the relation between changes in the nominal quantity of money and changes in nominal income is almost always closer than and more dependable than changes in the quantity of money per unit of output and changes in prices. But again, the lags are long and variable. So although he says that it's predictable, there was this caveat that sometimes the time between an impulse of monetary policy and its effect on inflation, well, that could be long and variable. Empirical work, and I think early work by Friedman suggested that something between 18 months to 2 years is about the kind of lag in effect. Okay, well, let's look at a possible channel for money and how money affects the economy. Let's start off here on the left-hand side, this box here, which has disequilibrium money. Okay, when money supply does not equal to money demand, what happens? Well, there's too much money in the economy, and this gets pushed into financial markets. That money is used to buy assets, which drives up asset prices. These asset prices being pushed up drive down the cost of capital. They also increase the value of financial assets. And these will have a direct effect on investment spending, or perhaps more financial activity, which then again has a second round effect on asset prices and so on. Some of that money will feed into goods markets, and we know how that works. Patinkin's real balance effect would say that if people had too much money, they would spend it, they'd get rid of it by passing it on to others, and then others would have too much money, and they would, of course, be exchanging it for goods. So money will be going in one direction, goods will be going in the other direction, and this keeps going round and round until, of course, goods prices start to rise. And that would have an effect on money GDP through an expenditure mechanism. Or, of course, some of it can go into real estate, and that would lead to house prices rising. And again, that has an effect on wealth and a second round effects on expenditure. Now, this is a very broad caricature. Of course, Friedman was right in saying that there are lots of other ways that money affects the economy, and I haven't thought about it, and I can't I can't tell you all the channels, but this is a rough idea that tells you how it'll work. Now, all that feeds into money GDP, and money GDP can be split up into real output and inflation. So initially, you might find real output increasing faster than inflation, but then as we hit capacity constraints, inflation comes in. And what told us how we split nominal income into inflation and real output was really the expectations augmented Phillips curve. Okay, so as long as there was a trade-off between inflation and call it unexpected inflation and real variables, that would be reflected in the break between inflation and real output out of money GDP. Okay, well, let's look at the basic pattern of money growth and nominal GDP growth. And what I've done here is I've taken a 6-quarter moving average of nominal GDP and plotted it against a 6-quarter moving average of M4 growth. It's a very naive thing to do. It has a correlation of about 0.4 something, but looking at the pictures, you can get some ideas about the peaks and troughs. You can see here that money, the red curve, and nominal income growth, the blue one. You can see that, money leads, and then after some time, we get nominal income growth. And here again, peak, and so on. It doesn't always work, but there is a rough correspondence. Well, of course, the more you smooth out the cycles of money and nominal GDP growth, you get a higher correlation. So you can see here for 6 quarters for the current, oh, I haven't got that in there, sorry. For the 6 quarters is 0.45. For the 8-quarter moving average, it's 0.55. So it keeps increasing. And when you get to 16-quarter moving average, of course, correlation gets bigger. So a stronger correlation between the two are really indications that the underlying variables possibly are, in the parlance of econometrics, are co-integrated. But correlation does not imply causation. We need to go further to get at that. Now, to do that, we need to bring in expectations. Now, if we start off with expectations, with Marshall's static expectations, that's exogenous. I mean, what Marshall was talking about, something that came from outside the model, we can think of that as exogenous. Inelastic expectations, that was very favorable in Keynesian type of thinking, was that expectations are governed by history, and people might use the most recent history, if it as a guide to expectations, and they would stick to that for a long time. Adaptive expectations is a sort of error learning mechanism where expectations would be driven by most recent activity, but if most recent activity was moving, that would change future expectations as well. And so adaptive expectations was always trying to catch up in the sense that it was error learning. You know, if you made an error, it would adjust expectations by some fraction of the error it made in the previous period. Bayesian expectations were conditioned on information, and you would use that to update your expectations as information changed. And of course, rational expectations said that you use all the available information. Now, rational expectations assumes that you know how the world works and there's one true model. Of course, that's not true. We know that we have many competing models. And so what the insight of rational expectations is to, if you're modeling expectations, is to make it consistent with the model you're using. And in some senses, it should be called consistent expectations, as it should be consistent with the model that people are using to explain the economy. And that's the way rational expectations has gone. It's become specific to the models that forecasters are using. Well, let's look at a model and look at two examples of these expectations systems. Adaptive expectations, this is pi is inflation, and E superscript means expected. So the change in expected inflation is some fraction of the error made between actual inflation in period T and expected inflation in period T. Now, this is adaptive expectations, and it's backward looking. It's not unreasonable to think that, say, for instance, households who don't have access to lots of information might use most recent inflation as a guide to expected inflation. So it's not unreasonable. It's the most economically efficient thing to do. Then we have rational or consistent expectations. Now, these are forward-looking. These are conditional expectations. They're conditional on all the information that exists relating to that model, in fact, at time t. And they would expect those who are making forecasts or making an expectation, they will try to do the best they can. And therefore, the difference between actual inflation and expected inflation will be a random error term. The argument about that is that you can't forecast the error you're going to make from an expectation. And so that if there was an error, that error is going to have a mean zero because you can't forecast it. It doesn't mean to say you get it right, but you're going to try and do the best you can. And that means that this error will be a random term. Okay, now, why am I spending time talking about this? It's because the world is, I should add that having read Tim Congdon's book recently and his previous one, he calls these gadgets. These are gadgets which are quite useful as classroom tools to explain things in the classroom. And they're intellectual props, right? They help us to order our thoughts about how expectations works in our models and what dynamics they produce. And that's very important. So I'll come back to that in a moment, because adaptive expectations, you can see being backward looking has a lot more inertia, whereas rational expectations moves very rapidly. Because if you make a mistake and you recognize that that mistake has a bias in it, that means you're underestimating inflation too often, you correct for that quickly and try to do the best you can, and therefore move towards a random error in making your expectation. Okay, let's put these two expectations systems into a very, very simple model. Again, it's a gadget, all right? We have the first one here is the demand for money, right? Where P is the price level, Y is real output, and we don't have an interest rate. We simply have expected inflation, future expected inflation. We have a money supply growth given by a random error term, and we have a supply curve which is like an inverted Phillips curve, which has got some propagation here, which is a lag term. So if there's a shock, right, an unexpected inflation here, where inflation is not equal to expected inflation, that shock is the impulse, and this is the propagation, which drives it and gives you a business cycle. Okay, well, if we put these through, we'll find that the characteristic equation that describes the dynamics of inflation with adaptive expectations has got a lot more inertia. Okay, it's got lots of lags, whereas the one with rational expectations got fewer lags. Well, these are, as Tim Congdon said, are gadgets. They're useful intellectual tools, but they're not reality. But they do have behavioral insights, okay? With adaptive expectations, the behavioral insight is that people use the most recent past to forecast inflation and use that as their expectations, but they're slow in adjusting. Well, that may well be true for some part of the population. With rational expectations, people are trying to do the best they can, and that their behavior will be different if they anticipate something than if it was unanticipated. That's all it says, right? I mean, of course, underlying rational expectations is the assumption that we know the true model and so on. We don't need all that. We just need to look at what's the behavioral insight. And the behavioral insight of rational expectations is that behavior is different if something was anticipated as opposed to it being unanticipated. And that turns out to be quite important when we go to the empirics. Because if something, in this very simple model, if something is anticipated, if an increase in money is anticipated, that has no effect on the real economy. It's only if it was unanticipated. But if it was anticipated and because of frictions in the ability to change prices caused by, say, contracts or some other kind of friction occurred, you might anticipate something and inflation expectations might rise, but actual inflation cannot follow up because you're stuck in with contracts or some other kind of inertia or friction. Well, if that's the case, then inflation expectations could rise sometimes before actual inflation. On the other hand, if it was unanticipated, actual inflation would be higher than expected inflation. With adaptive expectations, if there was a monetary impulse, a positive monetary impulse, actual inflation will always be above that of expected inflation, because expected inflation is playing catch up, is trying to get closer to it. Okay, so it'll take some time and finally expectations will catch up. Both these are gadgets, but both have some behavioral insights, and the real world probably has a bit of both and some other stuff which we haven't put in here. If we take a diagram from McCallum's book, Monetary Theory, we can look at, for instance, the effect on the price level of a shock to the rate of growth of money. So in our model, we had that the rate of growth of money is given by mu plus an error term. Okay, if there's a positive shock, the rate of growth of money stays the same after the shock, but the price level will have changed. So we'll have the same trajectory for the price level. It has a positive shock and moves up to a higher price level until the next shock comes along. Well, what happens with adaptive expectations? With adaptive expectations, we have this slow adjustment of expectations catching up with actual inflation. And all this here is unexpected inflation. That means that if there's unexpected inflation, the trade-off from the Phillips curve kicks in, and we have a real output effect. Here, we have the expected price path for rational expectations. If it was unexpected, then the black line, which is actual inflation, is going to be higher than expected inflation, the blue dotted line here. And there will be real consequences from that. If it was fully anticipated, then it'll have zero effect. Now that's in this particular model, but suppose I introduced some inertia in this model with contracts or frictions that do not allow the price level to adjust immediately, then expected inflation would rise ahead of actual inflation, and they'll both rapidly catch up in the new equilibrium. Okay, so these are the insights that you get from these different approaches to modeling inflation expectations. Where do I get my data on inflation expectations? Well, I can get a short-term inflation expectation from the Bank of England. They survey inflation expectations. I use the median inflation expectations data from that, and I combined it with the NISA forecasts, which you can also get on the Bank of England website to go back in time. I can back out medium-term inflation expectations from the implied market inflation expectations from 5-year index-linked yields from Q1 1995, and before that I assumed a fixed real rate of 2.5 for the previous quarters and backed that out for the period and call that a medium-term inflation expectations. You can also get a measure of long-term inflation expectations by looking at the 20-year bond yield minus estimates of the equilibrium real rate of interest, which I took from Evans, published in Economic Affairs in 2020 as 2.11% for 2082 and 1.9% thereafter. Okay, so I use these to get measures of inflation expectations, and I plot that against inflation for the period 1972 Q1 to 2024 Q1. The blue line here is actual inflation. The red one is short-run inflation expectations. The green one is medium-run inflation expectations, and the black one is the long-term inflation expectations. Now, whether you believe these numbers or not, these are the measures I've taken out in accordance with what we think are decent measures of inflation expectations. Now, what you can see here is that this here is the noisy period, all right, in the 70s, and then in the 90s there was a quiet period, and of course there's another noisy period here. I could, of course, look at simply the quiet inflation period, because that's probably favors econometric estimation, but there is information content in the noisy period. And so what I did was I looked at the whole period to see what you can get from this. Now, I should add that my results are entirely preliminary, and this is just a start to think about what we can get from the data and to help us to answer this question: money versus inflation expectations. So what I do is I use a VAR, a vector autoregression system of 4 equations, the log of M4, inflation expectations, log of nominal income, and inflation. And the ordering is M4 inflation expectations, nominal GDP, and inflation. And that's important because the ordering reflects the idea which might affect which variable first. And we could play around with that ordering at a future date if you don't like this. But there are 3 models: a VAR that has short-run inflation expectations, that's the survey data; a medium-run inflation expectations, that's inflation expectations extracted from the 5-year bond rate; and long-term inflation expectations data, which is extracted from the 20-year bond rate. And we examine the full period, which includes noisy inflation and quiet inflation period. And we're using 12 lags dictated by the AIC. Okay. Here's the Granger causal null hypothesis model 1, which means we're asking here, do these variables, can these be eliminated in explaining the M4 equation, or can these variables be used to be eliminated from explaining short-run inflation expectations? what I want you to look at is this, okay? This is the short run, the survey inflation expectations. Actual inflation actually helps to drive expected inflation, right? Very strong. We cannot reject it. Down here, the inflation equation, very strong, has M4, inflation expectations, and nominal GDP. They're all working to drive inflation in this, right? Now, that sounds reasonable because, you know, of course, we want to look at what the long run says, but these are what the econometrics tell us. So to look at the effect of, say, money, taking one of these on inflation, we do an impulse response shock to M4. Now, this is one standard deviation of the sample, and this is showing here how money rises. And when we look at inflation down here, what you can see here, this 0 here is it tells us the deviation from base. And the blue line is the impulse response, and these two upper and lower bounds show you the standard error bands for the standard 95% confidence interval. And what you can see here is that here's the 5th quarter, 6th, 7th, 8th here. This one is significant. So what it says is that inflation expectations responds 7 quarters to the money stocks. You can see that here, right? Whereas inflation responds 5, sorry, I was wrong, 6. Well, not 6, it's about 7, I think. 6 or 7, hard to see from this. But inflation responds 6 quarters to the monetary shock. So what this first thing is saying is that 6 or 7 quarters lag in effect. That's about right. But inflation expectations is either concurrent or pretty much, actually, no, it's a lag. It's saying that inflation expectations responds 1 quarter later than actual inflation. So that's suggesting that inflation expectations is backward looking using this survey data. Not unreasonable. This is the impulse response for a shock to expected inflation, and it shows the expected thing that a shock to inflation expectations affects inflation. But, you know, a shock to inflation expectations is like asking, you know, where does it come from? You know, why should inflation expectations be shocked? I mean, it's in a full model, it'll be endogenous, but anyway, it shows that inflation expectations does actually affect inflation. Now let's look at the same thing for model 2, where we have medium run inflation expectations. Again, we see here that inflation helps to drive inflation expectations. So there is some feedback from inflation to inflation expectations. But here we can see that M4 directly influences inflation expectations. Also down here, we can see that M4, inflation expectations, and nominal GDP all help to drive inflation. So with this result, we not only have simply inflation feeding back into inflation expectations, but money directly influencing inflation expectations. So how does that look with the impulse response functions? Well, here we are. We can see here that we are at this point, the lower standard error band is above 0, so we're significantly different from 0 here. And inflation expectations responds 5 quarters to the monetary shock. Whereas here, we're still, inflation responds 6 quarters to the monetary shock. So what we've done is changed the measure of inflation expectations. We've got more of a forward-looking variable in here, but not a very far forward-looking variable, just one that's got 5 years ahead, but it's changed the dynamics, right? Inflation expectations are affected slightly earlier than actual inflation. Okay, and now let's look at model 3. Model 3, still we have inflation affecting long-run inflation expectations. And I've written these in green because they're not as strong, significant, but they are still pretty good. They're, 95, they're within the 95% percentile here. So we are 0.0133. We cannot reject them at the conventional levels of significance. And down here, again, the inflation equation is being driven by M4, inflation expectations and nominal GDP. But the impulse response functions are slightly different. Let's look at inflation. With inflation, we can see, again, inflation responds 6 quarters to a monetary shock. The lag in effect is very consistent, but inflation expectations respond with a 1 quarter lag to a monetary shock. So the more forward-looking measure of inflation expectation is the quicker it is for those expectations to adjust to new information. That new information is the shock. The shock occurs in time period 0, in time period 1, we know the effect of it. Inflation expectations move quickly. So you can see here, right? This is significantly different from 0, right? Then there's a little bit of squiggles going on, but by and large, it reacts very quickly. So this is saying that the measures I've used are consistent with the kind of models I've used for inflation expectations. Of course, the real world will have a mixture of all these things. I don't use them both because that would require a different type of model, one that perhaps has more structure, because, the trouble with VARs are that with 12 lags for each, they eat up lots of degrees of freedom. You don't have a lot of degrees of freedom to play with. Okay, so what's the visual interpretation of what I've found? In model 1, M4 influences inflation, and inflation expectations feed on each other. In model 2 and 3, M4 affects inflation directly, but also affects inflation expectations, and inflation expectations affect inflation. So there's an indirect effect, okay, between M4 and inflation through inflation expectations. So what we can see then is that inflation expectations is not a new channel. It's not a new determinant of inflation. It is actually feeding back through its effects on the economy through money GDP and inflation, and the money supply has direct effects which then feed back into financial markets and the goods market, which feed back into money GDP and so on. And we need a more structured model to disentangle that. But for the time being, we know what the outcomes are. So results and conclusions. Well, first of all, inflation expectations has an influence on actual inflation, and inflation feeds back to inflation expectations. We have some evidence that medium and long-term inflation expectations is influenced by the money supply. Shocks to M4 drive inflation with a 6-quarter lag, which is comforting because that's roughly what Friedman said it would take, 18 months to 2 years. Short-term inflation expectations respond with a lag to inflation. Medium-term inflation expectations respond almost concurrently or 1 period ahead. Long-term inflation expectations leads inflation. So my point is that it's not inflation expectations versus money. It's not an either-or. In conclusion, money drives inflation, but money also drives inflation expectations. So what's the bottom line? Inflation expectations then are endogenous, right? They're not independent of monetary policy. Announcements and targets influence inflation expectations. In turn, that affects behavior, which influences actual inflation. But those targets have to be credible in the Barrow and Gordon sense, in the sense that if those targets are not met, there's a punishment and there's a loss of trust. And this loss of trust means that those targets are no longer credible and they no longer feed into inflation expectations. Therefore, credibility, which is very important for the argument that inflation expectations have to be anchored, must be earned through delivery. And delivery occurs if money growth is consistent with the target inflation. Thank you very much.
Thank you, Kent, for a very in-depth and topical discussion, and one that clearly deserves a lot more attention given the current economic climate around the cost of living crisis, central bank credibility, and obviously the change of government and what its potential spending plans are. We do have a couple of questions. I know that you were very detailed, so you've answered some of them already, but there's been a lot of talk recently about Bank of England mandates and if the inflation targeting is the best goal for monetary policy, or maybe there should be a move to nominal GDP targeting, either in growth terms or a nominal cash level. Do you have any thoughts on that?
Yes, I suppose if we were starting from now, we might think of a different target. We might have a price level target or a nominal GDP target, but we're not starting from now. We're starting with what we have. And I think, it's taken us some time to get back to the target, that we've been off target for some time. And credibility once lost takes a long time to win again. Maybe getting close to the target, it would be the wrong time to start thinking about changing the target itself. So in pragmatic terms, I think it's quite right to keep the inflation target, the one we know, and the one we have to earn, or the Bank of England has to earn its trust by getting back to it and sticking to it.
Great, thank you. Gerald Lyons asks a question, very topical given what's in the papers the last 48 hours or so. Thanks for a great talk. In terms of expectations, do you think there would be any benefit from the central bank as opposed to the government setting the inflation target? Obviously, the Bank of England has operational independence, but not goal independence like the Fed and the ECB. Any thoughts on that?
I think it's a very good idea. I mean, one advantage of the government inflation targets is the consistency. The danger that I would think about the central bank deciding it is that they might decide to change that for lots of good operational reasons, but with the government doing that, they are accountable. They're in a democratic system. They are accountable because if they didn't change it and it doesn't turn out to be a success, we can always, vote on them. It's not so easy with the central bank.
Sure. I mean, kind of following on from that, really, should the Bank of England have a price level target, which would offer greater long-term certainty, I guess, at the cost of additional short-term volatility, or should they stick with an inflation target?
Well, it referred to the answer to the first question, because if you had a price level target, we're obviously well above that right now. And to bring that price level back down to that target means the interest rates will have to stay up much higher and for longer, and we'll have to have negative inflation, which creates all sorts of problems about deflation. So my point is that we have to go from where we are. We have to accept that mistakes have been made, and that we hope that the Bank of England will learn from those mistakes and simply say, well, let's start from here. Let's say stick to our 2% target and try to win credibility for that.
Right. Gabriel Fagan asks a question on the different measurements of inflation expectations rather than on maturity. I guess it comes back to a question about, where do you place the weight? Should it be on the forward-looking bond market and 5-year linkers, or should it be on the survey data when it comes to inflation expectations? Have you found one more accurate than the other? Well,
accuracy was not what I was looking for in this modeling exercise. You're right. I mean, that's a very good question. And if I was in the forecasting business, I would go for a different kind of model. What I was looking at here was the causation business rather than the forecasting business. I mean, the Bank of England quite recently actually put out some discussion about money and nominal income and inflation cycles, and they admitted over long cycles there's quite a good synchronization between the two, but they concluded that for forecasting it's not very good. They may well be right, but we're not looking at forecasting here. I'm looking at trying to get at causation. if I was looking at forecasting, and I can't say which one is best at the moment, but yes, it's an interesting question, and that's an exercise for someone to do. What can you extract from the bond market for forecasting inflation, as opposed to the survey? It's a research project. It's perhaps someone's PhD waiting to be done.
Very good. Yeah, absolutely. QE was very good at dealing with the negative demand shock. Obviously, we look back at the global financial crisis, we see that, but not very good at addressing negative supply shocks. Why do you think the Bank of England increased the money supply so much in 2020? I mean, did they panic? You know, were they simply monetizing the new government spending at the time? I mean, what was their what do you think was their rationale?
You know, it would be interesting. It would be nice to think that they had a rational thought about, you know, monetizing the government spending, but I don't think that was it. I mean, sometimes decisions are more sort of cock up than
Yes.
you know than deep thought. I think it was the initial reaction. It worked with the global financial crisis, which is a very strong demand shock, and quite rightly, that was the right thing to do. But with a supply shock, of course, it's hard to know how you react to it. And the instant thing was government support, fiscal policy rising, and of course, you know, keeping interest rates low was a way of validating that, of monetizing that. But it may not have been simply, you know, let's monetize the government's financing decision. It could well be just that's the reaction of lowering interest rates when there's a shock to GDP.
Okay, I'm going to have two more questions, one from myself. It'd be very remiss, you know, given the work of the IIMR, not to mention this, but why do you think there appears to be such a reluctance to include the monetary aggregate to a greater degree in the current central bank models and their reaction functions? You know, why is this?
Well, that's actually a question I asked Hugh Pill once when he came here to the chief economist at the Bank of England. He came to give a talk here at Cardiff, because I showed him the chart of the rate of growth of money in recent years, and inflation, and the lag in effect, roughly about 6 quarters. And actually, he said that if he were to ever mention this, now I'm sure he'll forgive me for saying this, that his junior colleagues would all laugh at him and say, you know, that's not the way economics has gone. And I think what's happened is that there's been a capture of thinking in the economics profession that somehow that a DSGE model, that's dynamic stochastic general equilibrium model, can encapsulate everything we need to know about the economy. Obviously, that's a reaction to the reduced form approach of Friedman, saying that, you know, we've got some structure, but it's also a reaction against the large models. They're saying that we don't need large models, we just need very simple models. But these models are too simple. They don't include balance sheets, bank balance sheets. They don't talk about credit. And so we've gone away from reduced forms to structure, but not enough, you know. And the economics profession, particularly if you want to get tenure in a university, you want to publish. If you try to publish anything else other than a DSGE, you know, the referees wouldn't say to this is not what is the standard right now, and that drives the incentives to look at things in this framework. And in fact, you know, you can get quite far with it. You know, you can get quite far, but when it comes to the crunch, you can't tell what's going to happen, you know, in the very near future because of, say, money supply being exploding or contracting as it is doing right now.
Right. Right. We're going to end on the last question from Daniel Corrigan, who asks, great job, by the way, will the Bank of England cut rates on the 1st of August? Will they or should they? I mean, they should, but will they?
Well, yes, I suspect not. but yes, they should. If that's what Danny Corrigan wants to know, what my opinion is, yes, they most definitely should. And at the Shadow Monetary Policy Committee meeting recently, I voted for a 50 basis point cut. Others voted for a 100 basis point cut. So that's how serious we think that the bank is out of kilter.
Wow. So gradualism is out of the window. Okay, well, thank you very much again, Kent, for being with us today. We've taken up an hour of your time, and I really enjoyed your presentation. Very, very interesting. And with that, I'm going to wish you all a very good afternoon from London. Thank you very much.
Thank you very much.
Thank you.